No, he
Oh,
wasn't.
No.
We missed him
couple
in
of weeks.
Fujairah this time. Great, great. Okay, so we're all in. We can get going. Fantastic. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted to be joined by Peter Maguire, CEO of XM Australia, Andy Laven, Senior Partner of Econs, and Richard Radolia, CEO of Matrix Global Holdings. Thanks, gentlemen, for joining us today. Great to see you again. Let me start, Peter, with you. Let's talk a little bit about markets. Oil continuing to weaken. Tumble. Tumble was the headline in one of those bulletins. There's one result of a question we put earlier, which is, talking about the sort of risk premium really in the market and how that's been weakening really in the last month rather than strengthening. So, why is that? Just too much oil?
Oh, I think there's another side to it as well. And good afternoon, greetings from Sydney. I think probably the Israel-Palestine war premium seems to have dissipated a little bit. That's come out of the market. It's very evident now at $77.08 for NYMEX, and you've got Brent running at 81.50. So they've been all the hot air's come out of it, Diala, and it's been a time probably over the last couple of days to be short. This week been a very big week last week. S&P up 6% or just under. We understood what Powell's thoughts were as far as the Fed, and US dollars come off a little bit of pressure, and certainly everyone's sold energy and sold it down hard. And those export numbers, as far as what China thought that we may see a little bit of a bounce there, they were shocking. So I suppose that's the storyline that we've seen in the last couple of days.
Okay, thanks. Thanks for that, Peter. Andy, let's talk. I said, is it too much oil? I think there's agreement. There's enough oil around at the moment. OPEC is sticking to its cuts. It's probably likely to cut more now if we see this price direction continue. But what about demand? Richard, Peter just mentioned China. 5.4% growth this year. That's not bad. Considering what everyone was saying a few months ago. That's good for the new normal for China, isn't it?
It's good. It's not back to where they were, and I think there is some uncertainty about that. As we've seen, China is not maybe as robust as historically it has been, and I think that's, if there's anything that's uncertain in terms of demand, it's China. That plus, is it going to be a cold winter? And that's it really. So I think plenty of oil, some uncertainty about how cold the winter is going to be, some clear uncertainty about China's demand, and therefore oil is coming off. Everything else, to be quite honest, it from a pricing perspective is mostly noise. Now, clearly there's a lot of big noise out there like Israel and Pakistan and Palestine, but it's not noise that people are kind of having to listen to.
Okay, yeah, well, certainly the markets already absorbed that. Of course, nobody's saying nothing will happen in terms of physical escalation, but that's being discounted right now. Morning, Richard, or good evening,
Morning.
actually, probably.
Good evening. Yes, it is.
Just give us your take on sentiment, economic sentiment in the US now, as we sort of come to the end of this rather, healthy year for the US economy, despite, all the expectations earlier on. What are people feeling about 2024? Are we going to see this soft landing and soft recession?
It's hard to predict what that's going to be. I don't even dare give a guess to it. We are. I said this before the last time we talked. We're moving along. The United States seems to be relatively stable. Our demand is down a little bit. Gasoline demand has been down pretty significantly, and so it's nothing is great. Interest rates have gone flat. Peter just said the stock market made a big recovery. It's kind of everything is going back to sitting in a comfortable range. Two things. One, U.S. oil production I think reached its highest level ever in August. They're just above 13 million barrels. And I went back and we were talking about this just before we got on. I looked at the oil price. The oil price is almost at the exact middle of the last 20 years. So here we are in the exact middle of where the market has been. For 20 years, we've gone up and down and all around. And I think talking about it really is something that we get used to because we have to. But in reality, what are the other things that are going on? And I think, to me, one of the key things has been OPEC Plus. That's the biggest change I think it's occurred in the last number of years. They've decided they have a decision that they're going to keep prices stable. I think they'll probably see greater cuts. But I do think one of the things that we could see from the U.S., and this is kind of where I think our energy policy might have been a little misguided. We're at 13 million right now. Part of that reason is drilled but uncompleted wells have gone down to the lowest level in the last 10 years. So we've basically been using the inventory of what has been drilled, but we're uncompleted. So we're seeing that kind of coming back in and causing the increase. We've seen Chevron and Exxon make the large decision here that we are not going to go far afield to go look for oil. We're going to look in our backyard. And so the U.S. is kind of, and these large energy companies, I think we could see another decision by BP or someone else to snap somebody up, kind of turning away from the transition and saying, you know what, we better take advantage of this right now and use some of this money that we're making and look to make sure that we can maintain an oil production level that is going to be able to supply the market, providing the peak demand is not coming down the road just anytime soon.
Okay. Yeah, well, that peak demand scenarios, of course, still lots of disagreement there between the IEA and OPEC on peak demand, whether it's in the next few years, in a decade or so. Peter, let's just talk about, again, the oil price. It has dropped, obviously, in the last month, ironically, a bit, still, and so looking even more cheap. I mean, everyone's saying even at 90, oil is cheap because of inflation and because of historical values that Richard just mentioned. But versus other commodities, for example, how are other commodities doing, relatively speaking, in terms of inflation impact?
Well, if you put your mind across to the likes of gold, and there's a lot of ways that's decoupled, I think, against the US dollar, has been very evident. You had that very strong move to the upside, and gold's actually touched 2000 or 2010. I think it's about 1975 at the moment. So there's one instance. I think precious has been. You couldn't say that 20 years ago. Richard's example, you can't say the same about gold. You can't say the same. Probably you could about some of the grains. But there are some commodities that have shot very, very well to the upside and others that have languished. The likes of base metals have performed very, very well. And think of iron ore, think of copper, probably tin, aluminium and nickel and zinc. And some of those, dependent upon, the crop, some have performed incredibly well over that 20-year window or that period of time. The likes some, sugar, probably coffee, but others have, performed. They've been lackluster, and that's I suppose, the great attraction of these markets, Diala. You've got to find one from a trading perspective. I look at it from the lens that we look at it. We've got over 10 million clients, and they want movement. They just want it to be up or down. So I suppose it's a little bit unfair, but as Richard said again, we haven't been disappointed in movement over the last 20 years.
And how much is the China story sort of pushing those metals that you mentioned, which are doing relatively well? I mean, is that support is coming from China? Is it coming from the US?
I think it's a global demand. I mean, you've only got to go to, I was in, like my travels in the last month, I went to Mumbai, Singapore, Cranes Central. I mean, the cranes and the construction in India is just mind-blowing. UAE, I saw plenty of cranes and plenty of construction. So, it's just the need for raw materials hasn't gone away. The need naturally for electricity and how you're going to power these particular projects. And then you're looking at, the overhang, and this is where we're sitting now with 91 or 90 million uninhabited apartments and building and homes in China. What happens to that overhang? Are we going to see that get absorbed by the market, or is it going to be a great washout? And is Jim Chanos going to be right? He's been talking about it for enough years now to say that the Chinese property market's going to be the one that's going to capitulate everything. So the old story, someone's debt is another person's equity, and who's holding the debt? Domestic banks in China and 120 global banks. And you understand as well as anyone the contagion of that, because people sell the book, or they, use all these different exotic derivatives to manage risk.
Yeah, it's certainly a bit of a scary risk there. Andy, let's talk a bit about, I wanted to get to that with you. Richard mentioned the recent M&A activity that we've seen in the US shale patch. And we do have an article on BP, and there's been some talk in the market, is BP next? Are we going to see that being bought. I mean, in terms of valuation in the market, is it an attractive asset? And do we really see that sort of contagion, if you like, coming into the European space of M&A? Is this a good time for it?
So the simple answer is I don't know. I think for me, BP's probably at the top end of it, what anybody would be looking at. It would be a big company for anybody to buy out. You would have to have a really good valuation, and then I think you'd have to be very, very wary of the regulatory oversight in terms of overlapping assets, the amount of equity where they would have in various projects. I can understand why people are talking about it. A lot of change at the top, a lot of change in terms of strategy. One could argue lack of leadership, so they would be a prime takeover target. I just think it would give anybody indigestion, to be quite honest.
Yeah. And what about, I mean, we've had another pretty good year for oil companies, generally speaking, in terms of revenues, following last year's very strong, gains, windfall gains. Any indication of and again, Richard mentioned the likes of BP and Shell are sort of retracting a bit from their energy transition sort of speak, if you like. But are we seeing evidence of more money going into E&P? Are we actually seeing those new volumes, commitments going in?
So I think a lot of the major oil companies have got a challenge in terms of meeting what they perceive to be their external obligations and what their consumers and regulatory authorities want versus what they see in terms of reality. I think, in all honesty, if you sat in most of the board meetings of large oil and gas companies, you would hear a very, very similar conversation to what the oil ministers in the Middle East are saying. You cannot just turn energy off. You have to kind of keep moving forward. If you look at some of the immature markets like Africa, you cannot stop producing oil and gas for those. And if you just stop, you see what Richard was talking about. People use up wells that have been completed and you don't drill new wells. Well, guess what? You can't just drill a new well and turn it on in next 6 weeks unless you happen to sit in Saudi Arabia. Most places drill wells, they then do some seismic, drill some more wells, then they do an investment, then they do this, and 3 or 4 or 5 years down the road, you might have oil. So the reality of what people want and what makes sense is a very difficult place to be. So I think a lot of the oil and gas companies are struggling with that internally. And I think that's why you saw not just BP, but also Shell stepping back from their green commitments because they were suddenly realizing if we step back too quick, we'll actually run out of money because we won't be producing the oil and gas, which is give us the cash flow to invest in the green, and then all hell will break out. And that's no different from what Saudi's been saying for several years now.
Yep.
Yeah, and Saudi, of course, their cost of production, though, in the Gulf is much lower. Richard, on that point of cost of production, I mean, the shale cost of production has dropped well, the last few years through different sort of advances, I suppose, in technology. But at what price would they sort of start to pause again, having seen this resurgence a bit? Is it what, $60 the cost of production right now?
I think it's lower.
$80 oil price.
Well, yeah. I think it's it used to get, it was in the 40s, if not lower. But then the problem is after going through COVID and losing all the employees, then we've had wage inflation and just general inflation that's caused the cost to go up. I think it doesn't really matter that much because Exxon and Chevron and the other guys will just keep on buying them up, and they're going to drive their costs even lower, and they'll build a bigger pipeline to Baytown, and that's it. I think the mistake, and I've said this for a year or so or even longer, the issues are not now. Both the Saudi minister is telling us and the OPEC minister saying the rest of the world needs to get its act together and invest in upstream. Because if it doesn't invest in upstream, down the road, and I'm going to go with OPEC's belief that demand is going to continue to rise, not the IEA, which I believe is a government organization, basically saying what the government wants it to say. I think we're going to see a real problem. And so you've got massive amounts of money that have gone into the energy transition. I think the energy transition is in many ways a misallocation of massive capital. Ørsted just is stopping the 2 largest offshore wind projects in the United States now. We've got huge problems now with EVs are starting to show. show. Tesla, and I think it's called BVD, I think, whatever the Chinese electric company. They're the only two that really seem to be making any money. Ford loses $35,000 a car. So I think there's this misallocation of capital that has happened, and Chevron and Exxon kind of got away from its board problem it had a couple of years ago, and they've said we are going to invest in oil and we're going to spend a lot of money in it because we think that's where the money is going to be. But the question becomes really is, when we talk about the energy transition, we're all talking about how great it's everyone's moving ahead, full steam ahead. I wonder what happens in 2025 if we get new leadership changes in the governments of the world. What happens if a Republican comes into power in the United States? I'll tell you what's going to happen. Energy transition will stop dead in its tracks, and we will see oil production up. And to me, therein lies that, this shows you energy policy is really a long-term process, because we've never seen this before, where high energy prices always begat, and Andy just said it, production not today, but 3 and 5 years down the road. Imagine if we had been producing, 15 million barrels a day in the US. Imagine the political pressure that would have put on Russia, Iran, and Saudi. So here you have, energy policy which went totally green, which now is giving Venezuela a kind of a green card to go ahead. You can't make it up. You literally cannot make up the policy, which in my case, I believe is misguided. And I think the real question is going to be is we'll get through these couple of years. We're going to plod along. We'll go between 70 and 90 or whatever the number is going to be for Brent. But the real question is going to be is what happens when people get tired of, through inflation and higher prices, want to change in leadership. And will that leadership be all in on the transition? And my sense is that's a bet I wouldn't want to. Well, I know what I believe.
Yeah, and some people are making the other argument that people are so fed up with being beholden to oil price spikes when we have problems, when we have shortages, when we have geopolitical, that actually some people, of course, pro-transition camp will say, well, it's actually speeding up. And we need to speed up.
But it's not we went 70 years to build the oil infrastructure. 90 years has taken. We're not going to change in 10 years. It's just not. And so, yes, you might believe that a spike in prices should bring on the transition. And then what? We go to China to get our rare earth metals for EVs.
No, and I think it's very obvious from U.S. policy that you just mentioned the Venezuela loosening for 6 months at least. They're trying to experimenting there. They've turned a blind eye to Iranian extra oil. It's going to China, so they can't do anything about it anyway. Andy, let's talk about Russian oil. And again, the trend for expectations for next year. There's been some fallout domestically, on its economy a little bit. Obviously the revenue drop has impacted Russia a little bit, but obviously Russian oil continues to flow. Products, it's taking its own stance there now and then, just to squeeze Europe a little bit and elsewhere. What's the feeling for that going forward next year? More of the same?
Unless something changes between Russia and Ukraine, it is going to be more of the same politically. And I think the thing we also need to remember is that the sanctions and the structures that were put in place were never intended to stop Russian oil. If you stopped Russian oil, we wouldn't be talking about $70 a barrel. There is no way. It would be the 140, 150. Right? It was all about how do we reduce the amount of money that Russia make, and that's actually quite difficult to do, in all honesty, because we don't have a global economy with one government. Therefore, one person's debt is one person's equity. One person's cheap oil is other person's really good oil. Right? So it doesn't work. So it's going to be more of the same. It's going to be more complicated. It's going to be more logistically challenging. There is going to be lower margin. Russia won't make as much money per barrel, et cetera, et cetera. But it will just carry on like we've seen essentially with Iran. The market's balanced because it has to balance. There is not sufficient oil that you can suddenly turn off a whole country, virtually a whole continent, and just say, oh, well, never mind. So it's going to continue very much as it is.
Okay, Peter, let's talk a bit about, well, there you go. There's the question I wanted to actually put to you myself, which is a weak Eurozone and a weak China will keep the US dollar strong regardless of softening Fed rate cycle? We've obviously seen that the Fed policy indications are we could see things stabilize, let's say, more or less going forward, and the big question is when they're going to cut rates, obviously, next year. Peter, what do you think in terms of US dollar? It has weakened a bit, obviously relatively speaking, in the last week or two. What will support it more? What the Fed does, or demand, in other economies, weaker demand and weaker currencies?
Well, I think just the divergence between the Fed rate and ECB and the yen and BOJ, and probably to some extent to the Bank of England, is probably enough to keep the rate where it is, and the potential for possibly even further rate rises. That 150,000 that we saw in October for the NFP that dropped last Friday, that was another reason why you saw I think some of the good news entered stock markets. They realised that that's what they want to see, is a weakening or softness, and not as many jobs, and that whole discussion point. Are we going to see the Fed move again? Yeah, I won't be surprised to see possibly I don't think they'll do anything in December, but certainly maybe Q1. Australia lifted rates 25 basis points yesterday. That was our 13th raise. I think quite, matter of fact, I won't be surprised to see probably March, maybe the possibility of another rate rise. We've just got to see how retail sales go over Christmas, how unemployment is, how inflation is, and the value of the dollar. But the dollar where it is at 105.50, it's given up a little bit of hot steam, and it's very, very choppy, but it's a lot stronger than when it was at 101. So I think I won't be surprised to see it probably go up again from here. The markets are volatile, and I think that's what we're going to continue to see from now till the end of the year. Diala, is just big volatility swings.
Richard, in terms of the Fed policy in the US, is there is the sentiment that they're going to continue to be very serious about this inflation target of 2%? They're still double that. They haven't got there yet. Does anyone believe they're really going to keep pushing until they get there, or what else could come into that?
Well, I think they're getting close to the debt trap, right? If they lowered rates in the United States, the U.S. housing market would explode to the upside. U.S. housing sales are down, I think, the lowest they've been in like 35 years, because no one wants to sell their house because they have a low mortgage. So you have this massive pent-up demand. You had all this kind of free cash that's been printed. I'm not sure you're aware that the U.S. debt, I want to say it's the month, I think we had $1 trillion debt last month. $1 trillion debt in a month. I want to say it's a month. It might have been the quarter, but the next one's going to be 1.5 trillion. So the leadership is now having massive debt. So we have massive debt, which means massive printing of money. So I believe the Fed is seeing that. They know they have to keep the rates. They can't cut them. That just would be, that seems illogical to the extreme. It'd be crazy. It'd just be inflationary to the extreme. I think we just take off rents, housing, everything. I agree with Peter that, sometime in March, we probably raise the rates again. But remember now we're getting to the point of we're getting rid of all the 2, 5, and 10-year bonds that are at 0 interest rates, and they're being replaced by bonds at 5 and 5.5%. Our debt, I believe our debt payment now has gone from 600, interest on debt is from 600 million. I think it's approaching 980 billion, and I think it's going to pass $1 trillion in interest debt. So we're not like,
no way back. No way back.
We're not the Bank
No
of
way out.
Japan. We're not the Bank of Japan,
Yeah.
right? We're an open market, and so it's very problematic. I think it's going to be a very difficult. It's going to be a rough ride, I think, for the next year or so, as we go into an election year. Remember, next year.
Yeah, we'll talk. I want to come back to you on that. But Peter, I'll just jump to you on the Bank of Japan thing. In terms of slight change of tone there over the last week or two. But again, is that having any impact on markets beyond Japan?
Well, there was the talk of a change in their yield curve control mechanism. Yeah. The BOJ has been quite vocal in the importance of, just made some notes of earnings growth and all of those sort of stances. and trying to be accommodative. But the reality of the matter is you've had a Nikkei that's boomed to the upside. It's been absolutely on fire for the last year and a half or 2 years, 32,000, nearly 33,000. And you've got a yen that the BOJ is not worried about, and it's 149, 150, 151 oscillates between there, and they're don't seem to be too worried about things. So I suppose with a cheap yen, it's probably a contributing factor to their whole philosophy at the moment, and they're just playing their cards close to their chest.
Okay, Andy, let's talk a bit about Europe, just in terms of the economic sentiment. I mean, ECB policy, first of all, they indicated they were going to start freezing any more activity for now a month ago. So they've had enough. Basically, Europe's had enough of that. Is that the sort of feeling there? And and again, gas price spikes as we go into winter. Is there any nervousness around that? Lots of stock around, so maybe not.
There's a couple of things. I think we're much better positioned this year than we were last year. But I think the other thing that kind of going back to the point on interest rates is I think we're very, very good as human beings at forgetting the past. And I've made the comment previously. I remember when I bought my first house, our mortgage rate, the interest rate was 14%. In that context, what we're talking about now, which most of the people on the street would say is dreadful, is absolutely nothing. Okay, so we have become almost too used to a very low interest rate environment, and that's actually quite dangerous. You kind of need to have interest rates because people need to save and make money. You need to have interest rates because people have to work to pay back the money they borrow. If you give people free money, well, just keep giving it to me. I'll just spend it. I'll never pay it back. So I think we are, and this is what I think the banks, especially in Europe, are tiptoeing around, and the central banks are tiptoeing around, is like, well, we don't want to go higher because the public sentiment's not there and it's going to be damaging, not because of the interest rates going up, but because the public sentiment will be so bad. But we also don't want to drop it because actually we really don't want to go back down towards zero. We're kind of where we are is probably a sensible place to be, but nobody wants us here. So It's a very difficult balancing act.
Nobody wants tough times, obviously. A weak Eurozone, a weak China will keep the dollar strong, regardless of what the Fed does. Agree, 82%. So the relative value of what's happening in Europe and China will keep the dollar strong. Regardless. Richard, we'll go to you for the last word today. Give us a bit of please tell me that we're going to have other alternatives to Biden and Trump as this, unbelievable election cycle.
I don't.
Continues.
I
find someone in California, please.
We surely don't want Governor Newsom, so we don't want to find him. I don't know if there's somebody. I really don't.
Well,
I
Obama.
think. Yeah.
Sorry, I've exited Obama now. I've lost respect. I would have said that.
Yeah, Obama. I don't. It could be Michelle Obama. She could step in. I mean, I think that'd be crazy to the extreme as well. I mean, I'm at a loss, right? I am at a complete loss. I think everybody outside of a Republican in the United States hates Trump, right? So Trump is almost unseen to be. People can't stand him. Even though I think many of his policies were spot on and did all good things. I think his energy policy would have put us in good stead. Biden, I think, I'm not sure you guys are getting the news over there, but he is getting close to probably an impeachment trial next year for him. They've found the laptop from hell effectively it's a real laptop, and it has a lot of very funky information on it. So I think that's going to be problematic, and I think he is not fit to be president right now. But so there is none. I think you're going to have to just watch with the popcorn. We have popcorn, and we're going to eat our popcorn and see what happens. I tend to think that our bigger issues are kind of we're a divided country. We are right down the middle. And Andy, you said it earlier. No one wants to hear what the other side has to say. I don't talk anything to my best friends about energy, right? I'm an oil guy. I've spent 43 years in this business, and everyone has their electric cars. I'll be the last one, I think, to get one. But, I think what we're really at is we're in this situation where everybody talks past each other. There is no logic until there's no meetings of minds. It's going to be a very, very rocky road here.
Yeah, and not just for America. Unfortunately, we're seeing that division accentuate globally over many, many matters. Thank you so much, gentlemen, for joining us this
Thanks,
morning.
Diala.
Good to see you, and have a great remainder of the week.
Thank you so
Diala.
much. Bye, guys.
Bye.
Guys.
Bye-bye.
Yeah.
Bye-bye.
Bye-bye.
See you, Andy.